headlines told you gold made new highs. They did not tell you why that matters. I'm going to walk you through the bond market move, the public pressure on monetary policy, and the strategic signals out of Beijing, and then translate that into two decisions: how to think about duration risk now, and why a measured allocation to gold and silver still earns its keep. Now, I'm technically supposed to be on holiday this week, but the scale and mix of developments that has been going on warranted a super quick interruption. Headlines focused on new highs, with gold above 3,500 and dollar over 40. The more interesting point is what these moves coincided with: pressure in government bond markets, a public challenge to the idea that monetary policy can be insulated from politics, and a choreographed show of power in Beijing with Vladimir Putin and Kim Jong-un present. None of these observations, taken alone, is decisive, but together they help explain why investors rotated towards assets that do not rely on policy promises. And I want to highlight a few things I've read and been listening to this week to help us to understand what's been going on. The background is familiar, and I want to highlight something that Mario Inico mentioned just yesterday, as it's really key here. Edward Chancellor's The Price of Time reminds us that for much of recorded history, benchmark interest rates rarely fell below 3%. In the last cycle, major central banks drove the price of time close to zero, and in places, below it. Treating the policy rate as a primary instrument for growth support had consequences, and when the cost of time is suppressed, borrowing is encouraged, asset valuations stretch, and governments face fewer immediate constraints. So it is not surprising that debt loads rose, productivity disappointed, and many investors came to believe that lower rates were a near permanent feature rather than a cyclical tool. The adjustment that is now underway looks more like a reintroduction of price to the allocation of capital. Real yields have risen while market-based measures of inflation expectations have been comparatively stable. That combination suggests a shift in the required compensation for saving rather than a sudden change in inflation psychology. So investors are less willing to fund large fiscal programs at the rates that prevailed when balance sheets were expanding and policy was explicitly supportive. The message is pretty straightforward here. Resources are scarce, savings are finite, and confidence takes time to build, but very little to weaken. And bond markets illustrated this shift in concrete terms. UK 30-year gilts traded at yields last seen in the late 1990s, US 30-year treasuries moved towards 5%, and German long-dated yields reached multi-year highs. Japan's 30-year bond approached records near 3.3%. Now, Robert Armstrong in the FT noted that the long end of the developed market curves has softened together. Political circumstances differ, but chronic fiscal deficits are a common feature. Break-evens did not drive the move. The adjustment came through higher real yields, which is another way of saying that the price of funding has risen. And that is not a short burst of volatility, so much as a change in what the market requires to hold duration. Now, this matters because sovereign bonds have long been treated as the anchor of diversified portfolios and have been granted favourable regulatory treatment. But when that anchor moves, it affects asset pricing elsewhere. The week's action did not imply an imminent crisis, and it did underline that the assumptions which supported a long period of low volatility in rates are being tested. But of course, politics also made itself felt this week. The White House's move against the Federal Reserve Governor Lisa Cook, whatever one's view of the merits, was read by many as an encroachment on institutional space that is meant to be protected. And we covered this already this week. Once credibility becomes a topic of debate, it is harder to restore quickly. And the familiar pattern is that policy stays loose for longer than appropriate. Expectations drift, and subsequent tightening has to do more work. That is a bondholder problem as well as a macroeconomic one, because the term structure of interest rates depends on a degree of trust in the framework and the people who implement it. And of course, geopolitics provided a separate but very much related signal. Beijing's largest military parade in the nation's history was a statement of intent about China's role in the security and economic order. Markets translate such events into risk premia, higher hurdle rates, and a wider range of plausible outcomes. In the the microstructure of precious metals trading, there were also indications that Chinese institutions are exerting greater influence in Western venues. Elevated US gold premiums and episodes of volatility suggest that price discovery is less concentrated than it once was. Speeches very much indicate ambition, but flows reveal capacity. Taken together, these strands point to a straightforward conclusion. Gold's move higher coincided with a repricing of confidence. The sell-off in long-dated bonds reflected the scale of refinancing needs and the market's demand for compensation. The public treatment of the Federal Reserve highlighted the difficulty of keeping monetary policy at a remove from day-to-day politics. Beijing's display reminded investors that the strategic backdrop is shifting and will continue to influence capital costs. It follows that the advances in gold and silver are better understood as adjustments in the price of insurance than as momentum trades. These assets sit outside the policy tools that are currently under the most scrutiny. They do not remove risk, but they diversify it by reducing exposure to a single issuer's credibility. The practical message is modest and clear. First, holding some allocation can help offset periods when trust in policy and paper claims is being evaluated more rigorously. And second, these metals are likely to remain relevant through the adjustment, and not because of mystique, but because they are widely recognized and simple to custody relative to the promises now being repriced. In short, prices moved, but the meaning matters more than the magnitude. Bonds, bullion, policy, and geopolitics all contributed to a tighter price of trust. And in that environment, it is reasonable that investors paid a higher price for assets that do not depend on anyone's promise. And if you want to find out more how you can invest in gold and silver and get started, then click on the link below.